Hi everyone, welcome back to the Gen Y Investor. Thanks again for tuning in. If you enjoyed the video, please don't forget to like and subscribe. Hope you're all having a wonderful Easter. I've worked out the green screen function, so I've actually got a very nice backdrop. You guys are going to be getting some very nice backdrops in the future for my videos. That's just another joke. I'm actually out today at Mannum in the Riverland up here for Easter, so I thought I'd just jump on and do a quick video, but this is a legit background. Today we're just jumping on for a video on property investing. Doesn't necessarily need to be an investment property. It could, you could invest in property as an owner-occupied house. Still think that's a good investment. We're just going to discuss some of the pros and cons of it. We're going to talk about interest rates. We're going to talk a little bit about the property boom in the Adelaide market, but we'll also touch on Melbourne and Sydney. We'll also look at some of the interest rates worldwide as well, just for the overseas viewers. And yeah, then we'll round it off, I think. So let's get over to the slides. Okay, so I guess if you're looking to purchase a house, we just want to work out all the factors that are going to end up costing us when we're investing in a house, whether that be a owner-occupied dwelling or an investment property. And then we're also going to talk about some of the factors that might end up making you some money. So first of all, you've got probably one of my biggest hates is lender's mortgage insurance. Basically just insurance that the bank takes out against you, or that your lender takes out against you. Essentially, you need to get yourself to a 20% deposit amount to avoid any lender's mortgage insurance. And it scales up between 10 and 20%. It gets less and less as you get closer to that 20%. And then once you get over that 20%, like I said, you'll pay no lender's mortgage insurance. You have to actually add into account the fact that you're going to pay things like fees and stamp duty and conveyancer costs into your lender's mortgage insurance calculations. So if you plan on having a loan amount of $300,000 with a $100,000 deposit, you're actually going to need to lend a little bit more than that. So maybe striving for that 21-22% is probably a better idea, just because there's quite a few fees that will add on top of your loan. Then you've also got property maintenance, specifically with investment properties. You might need to paint the place, or you might need to fix the aircon or fix the gas or something like that. That can always end up costing. Then you've also got your interest payments that we need to pay back. Incredibly low at the moment, which we'll talk about a bit later, but still a cost that needs to be taken into consideration. Probably on, say, a $300,000 house, you're looking at between $5,000 and $10,000 a year of interest rate, which some people might call lost money, but that's not the way that I see it. You are actually paying off the principal as well for the most part, and then by the end of this period, you'll end up having a house, which is an asset. And then we got stamp duty. Generally, again, on a $300,000 property, it's about $15,000. $400,000 property, it goes up to about $20,000. This is in Australia. I'm not sure with your overseas whether they have stamp duty. I know that Tasmania doesn't actually have stamp duty, so perhaps a good place to invest in there if you want to avoid that fee, but not something that generally comes into consideration with most people. And then you've also got fixed loan fees, which are a little bit hidden for the most part, but you've got to decide whether you want to go variable or fixed. So there's benefits of both. Fixed, you can fix in a little bit lower than the variable rate, and you can fix it in for a long time if you think things are going to maybe go up, or you want some security to your loan. But there will be fees attached to your fixed loan. My package fee per year is $395. So that's just something that you've got to take into consideration. And then you've also got property agent or property manager fees if you're having an investment property. So typically that's about 9 to 10% of your rental income. It can be higher, can be lower, depending on who you get. I opted against going with a property manager. I usually do a couple of days of interviewing tenants, and then I'll decide on that and sort of liaise with my tenants directly. if they've got any issues, we talk through that. Just couldn't really justify paying, roughly $50 a week for someone to do what felt to me was quite a small task. That can be, it adds up. It adds up, $5,000 a year, even sometimes $2,500 to $5,000 a year, which is a lot of money. What else have we got? Council rates, revenue SA fees and levies and whatnot. So that's all, you're going to have to pay that regardless of whether you're an investment property or an owner occupied place. You might strike gold and get some tenants that are willing to pay that, but pretty rare. For the most part, landlords are expected to pay that. Then you've also obviously got to have insurance on your home. Investment property, you're probably just going to get insurance on the house itself. If it's an owner occupied, you probably need to look at getting home and contents as well as home insurance. We'll do a separate video on insurance another day, but I'm not a massive insurance fan, but this is one thing you can't really skimp out on, is specifically home insurance. If the house burns down, you're going to lose everything. So that's probably the one form of insurance I'm actually happy to fork out for. And then you've obviously got your capital gains tax if you sell the place. So you need to pay basically the gain of, say you bought it for $400,000, sold it for $500,000 a year later, you need to pay tax on that $100,000 profit that you've made. And if you're planning to positive gear the property, which basically means you're actually going to generate some positive income from this property, whereas a lot of people, I'll talk about it in the next slide, you would negative gear it, which means you're going to lose money initially on the property. You can claim back on tax. Positive gearing, you actually have to pay rental income, so you have to pay tax, and that's generally in the highest bracket as well. So you got to be careful of that. You might be saying I'm going to make $100 profit a week, but you're actually not making $100 profit a week. You're actually making 60 or 65 a week after the tax. So just something to be aware of. So not trying to turn people away from investment properties or buying their own house. It's just I'm trying to make it clear all the fees and costs that are associated with a house. Then things that can make us money, you've obviously got your tenants rent that comes in. You've got growth potential of property. Again, we'll talk about that in a second, but the housing market always up for the last ever, basically. It's only been going in one way, especially the bigger cities, Adelaide, Melbourne and Sydney. Probably can't really call Adelaide a massive city, but it's getting there. It's definitely rising in price. So you've obviously got growth potential that can make you some nice money. And then whatever you want to pay off on your principal, most people just do the standard payments, but if you want to pay back extra, that's straight into your, that's a straight asset to you because you're paying off like the actual loan of the house. You're not paying off the interest. And then we spoke about negative gearing before as well. So while that's not as many, these things can certainly generate you some good returns. Just because there's a lack of fees and stuff, that's sort of just the way life is. There's sort of fees attached to everything, but these are some good potentials for growth, I think. So just wanted to talk about why we might want to invest in a house, whether you want to live in it or actually rent it out. We've had a huge bubble. I don't know whether you want to call it a bubble. You can call it whatever you want, but the prices have certainly skyrocketed on houses in Adelaide recently. So we're almost mimicking what's happened in Melbourne and Sydney the past few years. It'd be great for you guys to let me know if anyone overseas is watching. Let me know what's going on with the house market in USA or Europe or whatnot. I'll talk about the interest rates in those areas in a minute, but I actually don't follow the housing market close enough in those countries. But Adelaide's certainly been on a very nice uptrend for the past, 10, 15 years, even 20 years. We look at 98. If you invested in houses in 1998, it's a bit over 20 years ago, you've seen a 500% increase in your investment. So that's just, that's up there with any great stocks, that's for sure. So certainly, as a lot of people will tell you, it's a very good investment in getting into the housing market. Whether you want to live in it or investment, again, I'm not making those decisions for you. This advice is just very general in nature. And I got a little article there just to exemplify this big boom at the moment a house in Mile End, which is in Adelaide. It's not a particularly nice area. It's quite nice, but it's nothing special. There's certainly nicer areas in Adelaide. Sold for $700,000 more than any other house has sold in Mile End before. So it went for 1.9 mil at the auction, and it was well over the reserve as well. So it's just crazy how much some of these houses are going for that you read about. And you actually note on the graph here, it's been the biggest increase since just before the GFC, which is right here. There was a big spike, but here's been the biggest increase. It hasn't actually increased an entire bar in one quarter since the GFC. So we're certainly in a bubble, and hasn't done this quarter, but this quarter will be like that as well. So we've got very high prices. This has just got the mean house prices of all the states, because I was just looking at median of South Australia before. Median and mean will be pretty similar with such a large range. So you can see that everything, especially New South Wales and Victoria, have had quite solid increases in the last 8 years. Northern Territory is one that's sort of stagnated a bit, but the rest are increasing quite nicely. And this is just talking about interest rates and how low interest rates are. We've got some of the reserve banks are into the negatives overseas. You've got Japan in the negatives. You've got the European area into the negatives. We're at 0.25. Actually, we'd be even less than that if you see over here. I wonder what that's exactly at. It's about 0.01 just about. So we're extremely low as well. USA, very low. And that's just the price the Reserve Bank set. So obviously your lenders are going to be a little bit higher than that. But for the most part, it's below 2% for especially owner-occupied houses. Investment properties, you have to be careful that they'll try and stiff you a bit. They'll raise the interest rates on your investments. I think I had a look today. It was CBA. I think they're about 4% for an investment property home. Whereas you don't really want anything above 2% if you're going with one of the big banks for an owner-occupied house. So another factor to consider if you're going for an investment property, you're probably going to have to pay a little bit more interest. And I just wanted to sort of talk about how much time has changed over just even the past 10 years, and what that means for us as investors, and what we're doing with our money. So you'll see right now, this one on the left is actually, if you take out a $300,000 loan with a 1.89 interest rate, over 30 years, you're only going to pay $93,000 interest on that loan. Now, people might think that sounds like a lot, but to me, it's pretty good. If you're basically getting a house and you're only having to pay back less than, it's about a quarter of the amount that you owed. So while you might say that's lost money, 10 years ago it was way worse, and I just don't think people got loans this big a long time ago unless you could pay it back really fast. So different methods of investing, and we need to take that into consideration. Like this one on the right, don't quote me on a 10% interest rate 10 years ago. I just know that it was pretty high about 10 years ago. It was up at about 7%, the Reserve Bank. So I'm guessing that lenders were probably doing it for around about 10%. 20, 30 years ago, it was definitely up at 10%. So, and when your interest rate's at 10% for a $300,000 loan, you're actually going to have to end up paying back almost $1 million over that 30-year period. Your repayments are way higher as well. Your repayments are $2,600 per month compared with $1,000 per month. So, everyday people with a job of say between $800 and $1,200 a week, it's pretty unaffordable and unrealistic to be paying back that sort of money per month. And that's the difference in that is just basically 2% interest rate compared with a 10% interest rate. Doesn't sound like a lot, but long term it is, and even short term your repayments go right up. So I just wanted to sort of talk about, to finish off, what we do with our money now that the interest rates are so low. And say we've bought a house, quite often you can have a bit of a variable and you can actually put some of your money, all your savings, into an offset account that sort of offsets your interest rate, and you actually don't have to pay interest on whatever savings you've got. Say you've got a $300,000 loan and your interest rate is a variable interest rate of maybe 3%. if you've got 100,000 savings, you can put that $100,000 against that 300,000, and you won't pay any interest on that 100,000 in your offset account. So again, people can do whatever they want with their money. I'm not here to tell you what to do, but it just got to me over the past couple of years. I'm just not saving that much money. 1.89% to save. Well, sorry, so my variable would have been a bit higher. Variable was always a bit higher. It would have been about 3%. My variable, to save 3% with all my money, it just didn't seem really that good. I'd rather try and make back maybe 10 to 15% on stocks, cryptos, and all this sort of gear. And we know the power of compounding. You can see on the image on the right what 10% can do. This is the bank getting that 10%, but 10% into my pocket. What is that? $300,000 over 10 years, turn it into $1 million. So we just have to start, as interest rates change, as the stock market changes, we just sort of have to adapt to that. So if you're buying a house, I would probably suggest to sort of not have it in an offset account. A lot of people do, and a lot of people like the safety and reassurance of that. So make your own decisions. But I just think in this day and age, it's a better idea to sort of maybe buy your house and then use your money elsewhere, because interest rates are just absolutely dirt cheap. $300,000 loan, that's $250 a week. So you can go, you got $100,000, you can go buy a $400,000 house. You get a very nice house for $400,000, and you'll only be paying back $250 a week. So I don't think that's unreasonable. I think that's pretty cheap, and just let it go and try and build your wealth elsewhere. That's the route that I'm taking anyway. But I know I've said it before, make your own decisions. This is not financial advice, but I hope you guys enjoyed the video nonetheless, and have a happy Easter. Thanks, guys.